Industrials plummet, down 0.6% this week, as bearish trends take hold, with the RSI at 59. Now is the time to reassess. Geopolitical risks are escalating. This is what every serious investor needs to know about industrials right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. This week, April 20th to 24th, 2026, the overall market context is characterized by relatively normal conditions, with the VIX at 18.7, indicating a moderate level of volatility. In this environment, the industrials sector is worth examining, particularly given its recent performance relative to the S&P 500. So far this week, the industrial sector ETF, XLI, has returned minus 0.60%, which is a notable deviation from the broader market. Given the sector's significant weighting in the S&P 500 and its sensitivity to economic cycles, industrials deserves attention right now, as it can provide valuable insights into the health of the economy. As we dive deeper into the sector, we will explore the key themes, trends, and drivers that are shaping its performance. Please remember, this is educational content and not financial advice. Let us start with the technical picture and what the charts are telling us. The industrial sector, as tracked by the XLI ETF, has seen a modest decline of 0.6% over the past week, yet remains up 4.46% for the month. The Relative Strength Index, or RSI, is currently reading 59, which implies that the sector is approaching a moderately overbought condition, but not quite there yet, thus yielding a bearish signal. This RSI reading suggests that the momentum is still with the bulls, but may be beginning to wane. The trend direction remains upward, however, the conviction behind this trend appears to be weakening. Key support levels likely exist near the recent consolidation zone, while resistance levels are likely to be found at the recent highs. The current move does not appear to be a sustainable breakout, rather an extended overreach, and as such, a period of consolidation may be in order. A specific technical setup worth watching this week is the potential for a pullback to the support zone, which could provide a buying opportunity, or alternatively, a breakdown below this zone, which could signal a more significant correction. Now let us look at the fundamental catalysts driving this sector. The industrial sector, comprising aerospace, defense, logistics, and machinery, is poised to navigate a mix of macro tailwinds and headwinds this week, with key stocks such as CAT, HON, UPS, BA, and GE offering insight into sector health. As we approach the GDP advance estimate for Q1 2026 and the non-farm payrolls report, these economic indicators could significantly influence the sector's trajectory. The current market regime, characterized by normal conditions, with the VIX at 18.7, suggests a moderate level of volatility, which may impact sector performance. The key stocks are signaling a relatively stable sector, with UPS and BA recently reporting earnings, providing a glimpse into the sector's resilience. Regulatory news and macro data, such as the forthcoming GDP estimate, will be closely watched, as they could move the sector. The longer-term fundamental thesis for being positioned in the industrial sector remains intact, driven by trends in global trade, infrastructure development, and the ongoing demand for innovative technologies. As we consider the sector's prospects, it is essential to remember that this is educational content and not financial advice. With the current market conditions and the expected economic releases, the sector may experience some fluctuations. Next, let us talk about the specific risks you need to manage this week. The industrial sector is facing several key risks this week, primarily centered around global trade tensions, supply chain disruptions, and rising raw material costs. These factors could potentially weigh on investor sentiment and lead to increased volatility. Given the current volatility environment, with the VIX at 18.7, it is essential to think carefully about position sizing, as even a moderate increase in volatility could result in significant losses. Unexpected headwinds, such as a sudden escalation in trade tensions or a natural disaster impacting key manufacturing hubs, could also pose a significant threat. To manage downside exposure, a disciplined framework is crucial, including regular portfolio rebalancing, stop-loss orders, and a well-diversified portfolio. By understanding these risks and implementing a robust risk management strategy, investors can better navigate the challenges facing the industrial sector. And now for the strategic outlook, where does industrials stand heading into next week? We maintain a cautious stance on industrials this week, due to rising input costs and supply chain disruptions, which may impact earnings. A key theme to track is the resurgence of infrastructure spending, potentially benefiting certain subsectors. This is educational content, not financial advice. If you found this video insightful, please like, subscribe to Financial Market Oracle, and comment your industrials watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.